Yeah, awesome. Well, first, everybody, thank you for coming. As you can tell, well, maybe you can't tell, I'm not Mark Hinteman. He apologizes for not being able to make it tonight, but I just figured, we could still get some value out of this and kind of talk about market cycles and, where we might be and how to make the best decisions we can depending on where we are in the market cycle.
Yeah, don't worry, Nick. We'll tell Mark you said that you're the better one out of the group.
Yeah. Pass that along. I appreciate that. Yeah, so diving into it, first things, is the market cycle real? Of course it is, right? We all have highs and lows. If anybody's paying attention right now, we're kind of seeing that swing going, so definitely it follows a regular cycle. So the best thing we could do is try and figure out where we are in that and adjust our investment strategy based upon that.
Awesome. So for anybody that's been in real estate for a little while, this is probably not new information for you, but there's essentially 4 market cycles to the real estate cycle. And this is a perfect graph that kind of depicts that. You have phase 1, which is your recovery phase, phase 2, which is the expansion phase, phase 3, your hypersupply, and your phase 4 in the recession phase. And we'll kind of go through this in a little bit more detail in a few more slides here. But this is, again, a representation of the cyclical pattern that we see typically in the real estate market. And this is something that's based on science, guys. This isn't something that we made up. This isn't something that, is just pulled out of anywhere. I mean, this has been historically a routine pattern that we see from previous trends. So why is this important? And this is such a relevant topic to where we're at in today's time, is where we're at in the cycle can affect our business strategy and our investment strategy. And it's important to know that, market cycles vary between markets to market. Although right now, as a whole, the country, we are experiencing an economic impact from the pandemic, and we're seeing that on a global scale. But it's important to know that, if you look at it from a micro level, what may be going on here in Houston may be very different from what's going on in Kansas, for example, or wherever else across the country, So, but again, understanding where we're at in these market cycles will really impact your business strategy. So again, what type of strategy are you looking to implement? Are you looking for the short term, more of a flip and dispose strategy? Are you looking for a buy and hold type of strategy? Are you going to invest for appreciation and cash flow or versus cash flow, It could also impact on where you're looking to invest. Again, if you're in a declining market, you may want to keep your eye on other markets that may be up on the rise and maybe going through an expansion phase. So loans, this is a big one. The debt and credit markets will vary depending on where we're at in the market cycle. And as we've seen here on the onset of COVID, things dried up very quickly, and the capital markets almost all but ceased and tightened up. And the reason being is the debt markets, the credit markets are really the first ones to know where these market cycles are going. So they're going to be the ones to really be able to identify where we're at in the market cycle. So, as we go through these various phases throughout the recovery cycle, you'll see debt changing. So, again, what type of product are we looking to invest in? Are you looking for your trophy assets or your workforce housing? And how is that impacted depending on where you're at in the market cycle? Right now, there's a lot of debate on whether we're on the top of the market or some people believe we may even be at the bottom. I feel like this conversation has been going on probably for the past 2 or 3 years. Most people have felt like we've been at the top for quite some time. I believe that myself. So right now, flight for quality is something that's emphasized. So, it can impact your timing of capital improvements and implementing your business strategy. And again, whether you're hurting.
I think there's a lot of echoes. I feel like someone's not on mute or something.
If everybody wouldn't mind, if you could mute your screens for me. me see. Try to mute everybody here. Cool. Is that better?
Good.
Awesome.
Yeah.
Cool. Excellent. So, all right, we'll go ahead and move on. Let's see. Abels?
Yeah, so like what with Cody was saying, also, you know, the market cycle also kind of affects how you feel about the cycle as well, right? So at that, you ride the highs, and you know, you also ride the lows too. So knowing, I mean, at different points of the market, you have different feelings, obviously. So I've kind of heard it yesterday. I was at a virtual investor or virtual asset management summit, and we had Jay Scott from Bigger Pockets jump on, and he kind of talked about how right now he feels that it's a tale of two economies. There's some that believe we're at the, I guess, top of the market, and some that believe we're at the bottom of the market, or we're about or going to. And so he kind of identified, like, you know, 5 pros and 5 cons for each side. So I thought it was pretty interesting, and I can kind of write up my notes and maybe send it out to everybody who was here tonight. So that's something cool. But yeah, so definitely being in that, depending on where you are in the cycle, you have different feelings about how you're buying. So yeah. Next slide, Nick. And yeah, so going with the chart that, you know, Cody kind of mentioned on, we have phase 1, which is recovery. So if you think about it, we're going back up from a down cycle. So we have declining vacancy rates. You have very little new construction happening, but then you also have the moderate absorption of units. Some of the strategies that we see then are having a value add plan, but, you know, waiting till the recovery. So focusing on prime markets. Cody or Nick, you want to jump on? But yeah, there's declining vacancy is pretty much the asset, and then you have no real new construction happening because it's towards the tail end, and you're now starting to build up in that certain market.
And then you have phase 2, the expansion. So during the expansion phase, it's a good phase to be in. There's high absorption, which means that your vacant units are being rented, you know, at a faster rate. So there's lower vacancy rates. It's really just a really good time to be, in my opinion. And then there's a value add strategy. There's, you know, deals to be made at any point in the cycle, but the value add strategy is, you know, one of my favorite because there's a lot of appreciation that you can do. You know, forced appreciation. You know, you can do a RUBS program, so many different things, and you really kind of, you know, you're on the slow incline before you get to the hypersupply phase, which leads me into my to the next slide, which hypersupply you have negative, so it's slowly starting to decline now. The absorption rate is now negative, so your vacant units are now becoming or staying vacant longer. You may have a higher vacancy rate. The new construction is slowly starting to decline. A lot of people try to sell during this time, and you kind of liquidate some assets and prepare for the recovery, so they can kind of hit that slope going back up again. So I mean, I just covered the kind of the peak and then the slow decline, and then you'll get into the recession, which I think Nick will continue.
Yeah, thanks. Yeah, so, you know, phase 4 of the recession. So this is where you're going to see, you know, increasing vacancy. You'll see some new construction, not a ton, low absorption for that construction, low to negative employment growth, low to negative rental rate growth. And this is, kind of the ideal time to start finding those fire sales, right? The steep discounts, bargain basement pricing, foreclosures, and it requires a lot of, they have in the notes. Yeah, it requires a lot of patience, liquidity, and then preparation before the market turns. So, be prepared. Being prepared for this, you can really capitalize when you start seeing those distressed deals. And this is a where are we now? Yeah, this is funny. 2019 mid-year viewpoint. So you can just see how it kind of breaks it down, which ones they project are in recovery, expansion, hypersupply, or recession. It's kind of funny to see, where we are, where they expect, 2019 to 2020. But as I think was alluded to earlier, there's macro trends, and then there's more local trends. So while some markets might be in hypersupply, others might be at the beginning of their expansion. Others might be recovering. It's good to know a general idea where you are. I don't think you'll ever know exactly, when you're at the peak. I think it's easier to find the bottom than it is to find the top. But at least you can kind of plan your game plan around, where your market's at. And yeah, there we go.
So I know we kind of whizzed through that a little bit. It was a shorter presentation, and again, it was prepared for Mark to kind of speak to. But again, it's such a relevant topic right now. If anybody's been in the real estate game for any period of time here as of late, you'll know that we've probably seen the longest expansion cycle in some time since about 2010. And there's a lot of debate, as Nick was alluding to just a second ago, of, are we at the top? Are we at the bottom? And really what that boils down is just to a lot of speculation. I mean, if we had that crystal ball to really be able to predict where we're at in the market cycle, obviously we can make, the perfect investment choices, but we're not. And so it's important that we pay attention to, what's going on in our markets that we're looking at. One easy trend to follow is look at pricing. Watch your pricing in the markets out there. That would be a big indicator of what's going on in your area. Talk to your lenders. Again, lenders are usually the first to know when cycles are changing and when future impacts are coming. And so you'll see that in their debt terms and whatnot. So, it's just being prudent to what's going on in your area. So.
Yeah, and I'd be interested to kind of hear where everybody's seeing, in their markets. But right now, it's kind of an interesting time for what we're seeing. And I think, our game plan right now is to find quality assets. We're kind of staying away from the C class, trying to find more of the B, maybe A minus, and kind of follow that, that quality. Because what we're finding is they're all trading near the same cap rates. Mm-hmm. Right. It's kind of a weird position we're in where, vacancy is increasing, rents are decreasing, but prices and cap rates are compressing. So, I think I didn't coin this term, but I think there is a flight to quality assets and staying away from lower ones right now.
Yeah, absolutely. I'd be really afraid to get in some short debt terms, with bridge debt or whatnot, and in hopes that you'll be able to refi here in the next year or two. I think that's going to be a risky play. Again, I voiced this a minute ago. In my opinion, I do think that we're kind of nearing that very peak of the top of the cycle. I'm not an expert by any means, but I mean, you could just see it. It's like how much longer can we sustain with the pricing and the valuations that we've seen? And Nick, like you said, I mean, we're seeing the same thing here in Houston. I mean, your C-class product, it's trading for, just shy under, that B plus assets. And that's where it gets scary. That's where it gets a little hairy. So, being prudent and doing your due diligence and making sure that you're buying right, especially right now, is going to be huge and very, very important over the next coming years for sure. So anybody want to chime in on what's going on in their market or what you're seeing?
I mean, I would agree with you, Cody. I think in Houston, it's been difficult finding something. I think a lot of the BC class properties, to Nick's point, the cap rates are, pretty level on, across all. And the price per door for C classes are, just as high as the Bs and maybe the A minuses. So, but I think that, obviously everything's cyclical. Yeah, I'm not sure what part of the market we're at right now. To your point, I don't know if we're at the top and we're about to go into hypersupply, but I still see a lot of construction around. New apartments are still going up here in Houston. So that's what I've been saying.
Yeah, absolutely. Let's see. I'm gonna call out Bailey. Bailey, what you seeing over there in Florida, man?
I'm seeing some high prices. I saw something today. It was a class C, not a great area at all. I actually drove by it and didn't want to just walk out of my car, and it was at 187 a door, which was super high compared to, for a class C, not in great shape, in a not so great area. And this was like a pretty credible broker too that I know that was listing it. So definitely prices are high for all asset classes. And Nick, like you said, you guys are going for the A class because there isn't, as far as a cap rate concerned, there isn't much difference. And the prices for these C class properties are also super high. So I'm kind of seeing very similar things here in Orlando, Florida.
Mm-hmm. Mm-hmm. If Hendra's still there, I know Hendra's in California. Hendra, would you mind speaking to what you're seeing over there in California?
Outrageously expensive, I can tell you that. But, to that point, though, a lot of investor in California is moving to the east, right? The first thing they hit is actually Phoenix. And I just spoke with Alyssa Zhang, which is, and then I think she mentioned about they're asking $178,000 a door right now in Phoenix. So that's pretty
for
crazy.
Class B or
it's actually a C class, workforce housing. And then unfortunately the spillover from that demand goes to Tucson, which is basically become a tertiary market, which just has nothing, no major employer that impacted with that. So yeah, it's competitive everywhere. And then sellers are still in a pre-COVID mentality, like I'm going to be selling at top prices, unfortunately.
Yeah. Hey, that's such a good point. And Hendra, you brought up a good point there where, Tucson, referring Tucson to Phoenix. And, there may be some opportunity that comes out of this from these expanding primary markets in some of the secondary markets that are outliers, 45 minutes, maybe, close drive outside of the cities. Like you said, Tucson has just been blowing up over the past year and a half just because of the growth that Phoenix has seen. And so, as attractive as these primary markets are, again, when you're seeing your C class product trade at the same cap as a B class, it doesn't make a lot of sense, right? So, you may find some opportunities in some of those outlying secondary markets around those primary markets. It's a good place to look. But as you mentioned, man, it's a tough market right now, and I think that's what's unique about this cycle is it's not your ordinary. Well, I guess this past year, more particularly 2020, has just not been an ordinary part of the cycle, right? With the impact of COVID and that coming out of nowhere and how it's impacted our business, it's things just don't feel the same as quite like they have in the past. So,
hey Cody, there was a question in the chat. Are we still considered? I guess this might be a Houston thing or whichever market you are. Are we still considered in the expansion phase in 2020?
Yeah, great question. Again, it's I wish we had the answer to that. I don't know that at least I can't answer that. I wish I could. I agree. I think if you look around, just Houston, for example, you still see a lot of construction, you still see a lot of new development going on. And so that would indicate that, yeah, I could probably confidently say that we're nearing the end of an expansion cycle, if anything, for sure. But it's hard to tell. I mean, like I said, I wish we had that crystal ball. I wish I knew that answer. But
yeah, personally, I think any market where we're seeing, vacancy increasing and rents decreasing, I don't think we're in the expansion at that point. I think we're going elsewhere. And I'm certainly not an economist, and I usually don't make predictions. But I think what's unique about this time right now is that the debt is so attractive right now that you can go to these compressed cap rates. I saw Binky and Daniel on here. Hey guys, we were looking at a deal in Austin, and our debt quote was around 2.7%. 5 years IO. You can get pretty competitive on your going in price at that point. And then you also got lack of deal flow because a lot of stuff came off market when the coronavirus hit, but still heavy investor interest, and then people trying to escape other asset classes. So I don't know if this is a long-term trend or not. I think it's kind of a weird phenomenon that we're seeing.
Yeah.
You feel like we're going to keep seeing these really compressed cap rates because it shows that, hey, multifamily is still, rents are still kind of being made in this market as opposed to other asset classes. I guess for 3 to 6 months from now.
I mean, I think, it'll, until people aren't hitting their returns, right? I mean, that's when the asset class stops being desirable.
Mm-hmm.
They can only compress so much,
I would like to add something here. You might have seen everybody too. So we see a lot of big deals are hitting our inboxes. Pretty sure you guys are seeing that too. So what does that indicate to you guys? All these 400 units, 500 units or above, and these are maybe B class, A class. So I get some of the listings that I'm getting like brand new. So what does that indicate, with all your experience being in the multifamily for a long time?
Yeah, Nick, Kendra, you guys want to take that one?
For me, I think it's just people trying to capitalize on the high prices.
Mm-hmm.
If they can get out right now and get a premium, why wouldn't you? I don't know their model for why they bought it, but if they can make what they were going to make in year 5 and year 2, it might be worth exploring.
Because do you think it's going to trickle down to the other classes too, like B or C at some point, and people are going to start dumping those, and how the market's going to look like? I just wonder, it's not like Cody mentioned earlier, it's not a normal trend, normal market cycle. It's kind of a little bit more than that because we have other things happening like pandemic, COVID and all that. So people are kind of in a distress kind of stage, So how would you articulate that, just looking at all this situation, all the scenarios?
Yeah, I mean, I don't have maybe a better answer than anybody. But I think when it comes to pricing, as long as people are continuing to pay those prices, people will continue selling at those prices. I think, until there's a surplus of supply or it's not as desirable, we'll probably see those prices stay that way.
But the other question that comes to my mind is, just like syndicators like us or the people who are just trying to capture the market is like too competitive because a lot of people are jumping in. Like, people like, I will call myself novice because I just started in the multifamily for last few months and stuff, even though I might have, some educational background to base myself up or the IT background, I can say, business management and all that. But looking at that, jumping in, then you just like, you think it's like more like a competition among the syndicators to get the deals that's driving the prices in the market. Maybe it's not the true picture.
I think it depends on what level you're buying at, right? If you're buying like the big deals, you're going to be competing with different, syndicators and funds and things like that. So I can't speak to all their models. If you're buying the smaller stuff, you're competing with probably more private investors. But But you know, this probably isn't a very popular opinion, but I think going forward, it's going to the syndication model is going to be tough. It's going to be tough to find deals that fit for what most passive investors are looking for. You know, I mean, the markets that we focus in, Austin and LA, it's always been a very appreciation market, right? We're trying to force the NOI to refi and roll. I think you're going to see a lot more appreciation type deals where you're not seeing heavy cash flow, and it might be for the short term. But, you know, as far as from a syndication standpoint, it'll be tough, you know, and then you know, maybe it'll get to the point where, you know, you're not able to offer those returns. So nobody's paying that price. And then you'll start seeing prices go down, you know, and readjust. But
we're seeing a lot of that, like a lot of investors or a lot of syndicators are coming forward saying like they're, instead of offering like an 8 pref, they're aiming more towards like a 7 pref.
Mm-hmm.
And the whole industry is giving like a little bit of a lesser return. But I think just out of fear and you know, just the fact that there's some opportunity right now with some of the other stuff becoming available. I think in the bigger markets where everybody's focused on, we're going to continue to see some compressed cap rates. You know, it's going to get more competitive. I mean, if we're looking at anything over like 100 units, we're going to see a lot of competition because that's kind of where the sweet spot is. I don't know about the like if you're looking for like 50 to 100 units, it might not be so competitive if you're doing more of a direct mail type campaign. But I think what a lot of people might be overlooking is some of the submarkets, like the secondary or tertiary markets next to these bigger markets, which we really haven't looked into it either. But I know that a lot of what we've seen is really focused on the more predominant markets. You know, and it's like everybody's flocking. Everybody's trying to move their money to the big markets right now. You know, the popular places, and that's where all the competition is. I know there's not a lot of interest in California at all. I mean, I know there's a couple of pockets that are getting ready to boom. I know that there's some of the bigger areas that are just about to boom, like Huntsville, for instance. We were looking at a property out there. And the area is not quite there yet, but all the metrics point towards the area just getting set to explode, like Atlanta did a little while back. So we're kind of focused in that area. But I think just kind of in a nutshell, everybody's going to be scattering towards these bigger markets, and if you know, your sweet spot is 1 to 200 units or more, you're going to see a lot of competition in anything you're doing right now. So you just have to kind of expect to pay a little more, you know. And I think once we get to the point where everything's kind of saturated, that increase in rents is going to slow down, and everybody's going to have to like start moving to different markets and whatnot. But I would say right now, I would look towards the secondary, tertiary markets to where the population is going to start to migrate to. And if you look at any of the studies that they've done recently that are available right now, you can start to see the trends and where everybody's migrating to, like out of California or out of the bigger areas. And just I don't know. I would say that's probably a good place to start. You know, if you're trying to chase the markets that are about to boom.
Vinky, going back to your question, Jim had a good point. He sent in a message, but the larger A-class deals, it's possible that it's also just institutional investors that are taking money off the table to keep their powder dry, you know, for when the deals do come. Yeah.
That could be right. But the other thing, that question is just like, you know, you think we are driving the market, like as the syndicators, you know, we made it so competitive. We're like bidding against each other, and that's driving the market, you know, haywire kind of, you know, I'm just thinking logically here a little bit, you know, because we are the kind of who are driving the demand in the market, basically, you know. So if you look at the demand and supply curve, if you look at that, because I think few years back, fewer syndicators, market was different, but now more and more people are coming in, they're seeing the opportunity, everybody's jumping in. So you think that might be the reflection of the pricing going up, the market is going haywire, you know, because all the demand is increasing regardless whatever the situation or circumstances we are in, because there are so many syndicators there, and they're just like creating that demand, that kind of demand. And that's driving the cap rates as well and the pricing as well. That could be one of the factors. I don't know. I'm just looking at all the things that's going around.
Yeah, I think it's multifactorial, right? I think there's so many variables that play into that question, right? I mean, I do agree with your point, and I think over the past decade in particular, the multifamily asset type, and Nick, we were just talking about this in our breakout room, right? Where it's become the gem, right? It's become the popular asset type to pursue because it's been typically historically, very resilient in throughout most market cycles. And but I think, so yes, you have an influx of new syndicators, new operators coming to market that are, driving competition as well. But then I think also too, you have things like the tax laws and bonus depreciation also playing a factor in that. You have inflation and, things like that. And then you have this robust migratory pattern that we've been seeing, and particularly to the Southeast, that have been driving demand in a lot of these markets down in the South and the Southeast region. So I guess again, it's multifactorial, right? And I think there's a lot of variables that play into that. And, I think it's, and then we're definitely in an interesting spot right now, I think, as investors, right? And the big question is, well, do you continue to pursue? Do you continue to buy right now, or do we wait? I think the biggest thing is right now is just being more cautious and just being more disciplined to whatever your investment criteria is, and making sure that you're not getting an investment just to get into it. Making sure that you're not being over competitive just to get that deal done. Because for me, the big question I ask myself is, man, how much longer can we sustain the growth that we've seen? How much longer can rates continue to stay, caps continue to stay where they're at, and again, nobody knows the answer to that, but I would be more reluctant and hesitant right now, if things just don't feel right, I guess is my point. So.
Yeah, thank you. No, that was the right answer, that was really good. And then the other thing, I don't know if you guys have heard about the tokenization. They are doing quite a bit of work in that area too, right?
I'm sorry, the what?
The blockchain and the tokenization, they're making their space too in the real estate market as well, So I don't know if you guys heard about that too. So they're kind of penetrating too.
Yeah, interesting. I don't think I'm familiar with that one, but yeah,
that's if that comes into the market and it's good, it's gonna take over everything. Then if that tokenization happens, because then anybody can invest in any kind of deal, any portion of the deal, because of the properties, they are all geocoded everything, and if they tokenize the property, so basically you're like investing in the stock market, getting a token or buying a stock kind of thing. So that's gonna change the real estate landscape big time as well. But that's not going to be near future. It's not like that. It's going to go away 100%, the syndication.
Yeah, interesting.
Yeah, Jim is already receiving something.
Interesting.
He's getting the stress testing deals on that.
Nice. Interesting. So, awesome. Do we have any more questions? Let's see. There's another one here. How deep is everyone stress testing their deals? Underwriting to worst case scenario at what vacancy rates in Texas market C class deals, primary, secondary, tertiary? I have already started receiving deals that are accepting Bitcoin for LP.
Wow.
Interesting. Huh.
I guess there's a lot of ways to answer that question, but
yeah, go ahead, Daniel. What's your input there?
Well, I guess a lot of that has to do with just the way the property is performing. This far into the whole situation that we're going through right now, if the property's starting to show a lot of stress and a lot of deferrals, it's probably going to be something that you would want to be leery of, or that would raise a red flag for me, because if they haven't weathered the storm well up until now, there's people out there that aren't paying their rent just because they don't have to, and that's a type of tenant that we're really trying to stay away from. So if you just have to look over your T12s very carefully and it'll kind of tell you a story. After you've looked at a few, you'll start to just see a pattern. Um, uh, so anything has a pretty diverse job market and diverse tenant that's doing pretty well with the whole COVID situation and can work from home, and generally they can pay their bills, and they're not in a bad situation because of the whole ordeal. You're not going to see a lot of deferrals. There's some properties that don't have any deferred rent. Generally you're going to see a little bit of bad debt no matter what time of the year it is. But if the bad debt is minimal, if the deferrals are minimal, then I would say there's probably not much going to change. Um, because people have either figured it out or they're just a resilient tenant. Um, and if there's a lot of extra line items like deferrals and then bad debt and then debt recaptured or just all these different things that they're having to put in place, I would say that's probably something to think twice about or just look into a little more deeply. Um, and I mean, I guess that's really it. As far as the whole COVID thing.
Yeah, I think that's a good point. When you're looking at deals, look at the rent rolls, make sure it has a balance column, and look for any that are carrying large balances, right? We're starting to see more and more of those large balances starting to pile up, especially as eviction moratoriums carry on. As far as stress testing and deal finding right now, and I think somebody asked, like, should you be looking for deals right now? First, you should always be prospecting, because finding a deal takes time. Negotiating, getting under contract, sometimes that takes 3, 6, 9 months. So definitely don't ever stop your deal finding machine. But yeah, be patient, be picky. For stress testing, personally, I like to establish a baseline now of where the average rental rates are. I look at delinquency. I'm definitely not expecting any increase in income in year one, very little in year two, unless there's, something unique about the property. And then, personally lower leverage than we would typically pursue on a deal. And then play with the vacancy rate until you can see where your break even is and see, how realistic is, that you're going to hit, hit that break even. Cause it's a very, in the grand scheme of things, what we're in is a very short-term problem. When you're looking 5 to 7 years, you just want to make sure you can weather this storm and get it at a good price. But that's what we're looking at.
Nick, I would add to that too. I'd want to see what the NOI looks like, or the cash flow looks like after a fully amortized debt payment. Without interest only. I want to make sure that it can cover that. Because I think that's a mistake a lot of people are getting into is they'll underwrite 2-3 years of IO and the returns look great, but then what happens in year 4 when that goes away? Returns can slash. So I think that's another thing to factor into in your initial underwriting is looking at what it looks like without the interest only payment. So
yeah, good point.
I also want to add on that one to Nick's point that look at the OPEX, right? The operating expenses though, because there's many ways you can do in the first couple of years. That's going to be a big play. If they're not very effective, right? Not very efficient in running it, then you can lower it down. And by knowing your market, part of the third-party property management, that's going to be your valuation increase by that play.
Mm-hmm.
Number one.
Yeah, I would say especially if you're in the 70 to 80s vintage and you're buying from an owner who hasn't done any utility renovations. That's one thing we're looking at right now. It's a huge cost savings, right? Value add through operations instead of renovations.
Yeah, absolutely. All right, guys, do we have any more questions?
Yeah, I actually do. I have one question to branch off of what you guys just brought up. So when you do find a property that's got like boilers instead of like individual AC units, or like one cooler, and I don't know if the cooler has to do with cooling the property or like a water chiller. From what we gather, it has something to do with the AC. I'd never come across a chiller before. So has anybody ever run across that type of thing, and how do you evaluate a property like that?
No, I haven't.
Yeah, to be honest, man, I know for us, typically, those are going to be your older vintage product, your 1950s, 1960s product, even probably early 70s. And, just from our experience of what we've heard from other operators that have invested in those properties, that can be very expensive and costly to replace. And just that vintage product alone, I think, for us, we typically try to shy away from it, typically looking for something more, 1980s or vintage or newer, for that reason. And I think, we heard this spoken about, last week at a conference by a guy named Bill Helm. And if you don't know Bill, I definitely encourage you to look him up. Great guy, a lot of experience, but he talks about the CapEx tsunami that's coming. And basically what he's referring to is a lot of these, 50s and 60s, 70s product that people have been acquiring and then, just patching and then trading, patching and trading, and not really, really fixing the plumbing, fixing the electric components and things like that. Maybe boilers and chillers. People have just been putting Band-Aids on it. And then now here it is, this product's getting to be 50 years old. It's statistically, it's about time there's something to bust. Piping's going to go bad or something. And somebody's going to end up having to foot that massive CapEx workload. So, again, I just summarize it, again, we typically try to stay away from properties that have boilers and chillers and, that older vintage. So.
Right. No, good point. Yeah, we do generally too, but we had somebody bring us a deal the other day and we were trying to sit there and evaluate it with them. And I'd never come across a building that had a chiller. I didn't even know what it was. We had to Google it.
It's very common in 70s vintage and older properties throughout the Sun Belt, whether that be Arizona, New Mexico, Texas, very, very common. And the flat roof and boiler chiller, the two things that a lot of people are trying to avoid nowadays. But if you're buying in C-class properties in the Sun Belt, you're going to run across a bunch of those. And so you do want to make sure you get an expert on your due diligence team that is familiar with that. They're really not anything to be afraid of as long as you know what you're getting into and you know exactly what to look for. But they can be very expensive. But I think it was, no, it wasn't Ray. Anyway, someone I was speaking to the other day that when he goes in, even his individual HVAC, if they're 15, 18 years old or older, he replaces every single one of them when he takes over a property. And so if you're doing that kind of CapEx expense, that's actually probably going to be more expensive than a chiller if you're doing all of it at once. But there are some inherent disadvantages with chillers that can be overcome with technology, but in our industry, nobody is instituting that technology. So all of your high-rise buildings and your big government buildings and schools and that type of real estate, most of them operate on chiller systems. But there's what's known as a dumb chiller system, which is what we have in our industry, and a smart chiller system, which is what they have in theirs. In those asset classes. And there's a lot more automated valves, a lot more automated sensing for water flow, for temperature, all kinds of things that we don't use. So just a basic dumb chiller, if you have to go in and replace it, pretty much replace the whole thing. Each 100 unit typically will have one chiller system, and probably on average, most of them are a 90-ton chiller system. And a system like that will probably cost you about $200,000 to replace.
So on a system like that, I mean, I'm probably taking this off on a tangent, but on a system like that, does every unit have an individual louver that they can control?
Each unit will typically have a way to control their unit, but it is limited. It's not to the extent that you have with an individual HVAC, but yeah, they still have temperature control.
Thank you, Jim.
If you really get a really old, very, very, very simplistic, then, and especially if it was all bills paid, then they may not, because you as the landlord want to control it, to control cost.
Thank you, Jim.
Mm-hmm.
Hey, Jim, would you mind going back and speaking? I see your comment here in the chat box, and it goes back to the question I think you actually posed about what is everybody underwriting or stress testing their deals. And you had a very good comment here. Would you mind speaking to that?
Well, I think that, depending on what you think is going to happen in the near future in the economy, I've been expecting a downturn for a while. And I think that now that we've run out of some of this government money, there's going to be, I think that NOI is going to take a pretty strong hit, especially in C-class properties and especially in secondary and tertiary markets, and even the primary markets, whether it be a Dallas or a Houston or a Phoenix. If those people have lost their job and can't catch up, if they've been making COVID payments or they haven't been making payments at all and can't catch up once everything is over with, I just think we need to be prepared. You need to be preparing worst case scenario and have a contingency plan, and have a contingency plan for your contingency plan. So start looking at ways you can protect your cash flow. And so that's one of the things that I've been looking at very, very strongly for the last 9 months. In how to do that. But I would be talking to several different property managers in my market area, and I'd want to interview them with those questions in mind. What is the historical vacancy rate? Just like exit cap rates. We underwrite, most people are underwriting to X basis points per year at exit, but that may or may not be a very good way to underwrite a deal, because if you look at historical cap rates, they have been so freaking compressed, to Nick's point earlier, that they're not historically normal. So you may be looking at a 5 cap right now that historically is a 7.5 cap. And if we see a protracted downturn that takes those cap rates back to historical norms, then those deals are not going to work. They're not going to pay out. And so with historical vacancy, I'd be looking at that. And I would also want to know if my PM had been around during the last downturn, what was the worst that they saw? Not in every single property, not the worst case of the worst case, but your average C-class property. What kind of vacancies did they see? Was there a spike? How long did it last?
Yeah, that's great. That's a great explanation, Jim. Yeah, love that. So there's Mark.
Hey, how's it going?
Very good.
How are you?
Good. Sorry, I flaked.
That's okay. We won't tell you what Nick said about you, but
well, basically, haven't we all just been sitting here waiting, Cody, for him to show up?
Pretty much.
That's a good question.
No, man, Mark, we appreciate you at least chiming in. We were about to wrap up here, but we were just having some really good conversation about just what we're seeing as far as market cycles go and across the country, and really just kind of our perspective as investors on what strategies that we should be implementing, how should we be underwriting or stress testing deals, and yeah. So
yeah, that's a good topic. Interesting topic. Yeah. Has anyone had the answer? Had the right answer?
We've been waiting for you, Mark. We've been waiting for you.
We're waiting for you. That's right. Well, I mean, since you're here, give us your perspective. Where do you see us at right now in the market, and what do you see, or how is that impacting your business?
Yeah, it seems like COVID is hitting different segments of the economy in different ways, and some areas are thriving and others are struggling. And it seems, and you guys tell me, like, I don't know that there's still a lot of interest in multifamily. But I think, maybe it's a little bit by market to market, but, rents seem to be down. And, obviously the tenant population is getting hit by this recession. So I don't know. I think you just got to be careful. I think you got to underwrite conservatively. You got to factor in that we may not be out of the woods on the volatility. There may be increasing vacancy, maybe some rent declines. But I think if you underwrite conservatively and have reserves, I think you can survive it. But definitely be more careful than usual.
Yeah, I'd agree. Yeah, going back to Daniel's point you made earlier, and Jim, your point as well just a minute ago, understanding the T12 and what's reflected in the T12, especially as we're getting later into this fiscal year, is huge, right? And I mean, it tells a story, and I think you've been hearing a lot about collections remaining strong, but if you take a look at that bottom line and look at the NOI, that really tells you just how strong those deals have been performing. And we've seen deals that have had probably 20-25% decrease in their overall NOI from the start of the fiscal year. Yeah. So, it just, again, you hear it all the time. Oh, we're at 90% collections, but yeah, your NOI dropped 25%. So, it's just something to pay attention to. And like you said, just making sure that you're being very prudent and conservative in your underwriting and your judgment, for sure.
Yeah. I remember I told a lot of people this, that when I went through 2008, we got hit with this big event, economic event, and everything kind of crashed. And then it took a long time for the impact to be felt in the multifamily space. And it surprised me. And so that's the thing I took away from that sort of 4-year period, is when everybody thinks that it's done after 10 months, it's likely not done yet. And the effects on the multifamily sector are probably delayed, and they won't be felt right away.
Yeah, that's a good point as well. So it's kind of hard as an investor, especially right now, where there's always time and opportunity to buy, as long as you're buying right in the right market. Just knowing where you're at in that market cycle and buying right and implementing the right strategy in that market cycle. But definitely right now, not that we want to sit back and wait, but it's definitely interesting to kind of be very patient and see where this thing takes us and what happens, especially going into 2021.
Agreed. Totally.
Yeah.
There will be a great opportunity, if you could keep an eye out and accurately predict, which is very difficult. If you could find the bottom, or kind of like devour as much economic information and know what's happening with retail and office and incomes, largely incomes and unemployment, so that you see when we are starting a recovery that's on solid footing, like that's the time to buy. And I think, it'll be one of those once in a decade opportunities to buy at great values.
Absolutely.
Honestly, I'd rather be at this stage of the cycle than be where we were at the end of 2019, where things were just had gone up so high for so long that there was just you knew that it couldn't sustain.
Yeah, interesting point. Well, Mark, we're definitely going to have you back.
Yeah, I'm so pumped.
We're gonna.
The timing of this, I got thrown something end of the day yesterday that.
Hey, no worries, man. We completely understand, man. I think most everybody here, we all got our own lives and things that come up. So we get it, man. We just appreciate you chiming in. And unfortunately, we've been on the call for almost an hour and a half now. So I think we're going to call it good for the night. But again, we're going to get back with you and see if we can get you rescheduled. How about that?
I'm glad I caught the tail end just to say hi. That's all I wanted to do.
Awesome. Well,
Well,
guys,
cool.
thank you so much for everybody that attended tonight. We really appreciate it. Made for a really great conversation. Mark, thank you again. We'll see you again soon. And
Of course. Yeah. Thanks for hosting.
Hey, great
Absolutely.
group, guys. Thanks, Cody, Nick, you guys for putting it on. Great group, great speakers. Mark, hopefully we'll see you soon.
Yeah. Yeah. Good to see you.
Awesome, guys. Thanks for all the great conversation, guys. Y'all have a good night.
See you guys.
Have a good night, everybody.
Everybody, to see
How are
you.
you? Good to see you too.